Right. Hello guys, welcome back to my channel. So today I want to talk about how can you avoid um avoid sort of getting wicked out of your trades, like having you're taking a position and then suddenly the market starts being aggressive or starts making these aggressive wicks. Something I really like to call the sort of the wicking the market. Something I like to call that. So how can you avoid like situations like this? This is mostly for scalpers. When it comes to scalping, a lot of us we use really tight stop losses, and we try to get either 1 to 1s or 1 to 2s. It's sometimes 1 to 3, but mostly for scalpers, you're gonna be looking at like a 1 to 1 trade, 1 to 2, 1 to 3. Um, but with doing so with the scalper, it's very difficult to get that correctly when the market's really aggressive. So I want to quickly talk about how you can avoid aggressive weak markets to improve your profitability as a trader. And also, I might sound really weird today because I'm kind of ill. So please do excuse that, and let's just get into the video. Right, just get rid of that. So, how can you avoid these wicks when you're day trading? Well, something you have to understand about trading is something called market conditions. Sometimes the market, yeah, as we all know, sometimes the market's trending down, sometimes the market's uptrending, sometimes the market's just going sideways and not really doing anything. But there's also different types of market conditions when it comes to the candles itself. So you can see these really large candles, but sometimes you can see really small candles like this. And this is what we call dirty price movements. It's not very clear, it's not very clean. As a scalper, you really want to look for market conditions that are a lot more clean and not like dirty, where you see these small candles, then you see a massive pull sharp, then you see these small candles again. That isn't very reliable price action. Um, and if you want to improve your profitability as a trader, you need more of a consistency. But let's say you're seeing this small downtrend going on here, and you want to get involved with it. The first thing you need to do is to think about what kind of structure is the market in. So we can see from this, we see that the market is pushing down, but it's not just pushing down aggressively. Like sometimes the market's just dropping. In those cases, a lot of the time you can just jump in and the market will probably keep on going, most times than not. Obviously, you have to consider, bottom buying or bottom selling or, top buying. But, when the market is just dropping, that's all well and good. But in this case, if you're a scalper and you're looking for a short in this area, a lot of us try to get these really small stop losses, say something like that, and sometimes we'll go for even a 1 to 1, 1 to 2, something like 1 to 2. There we go. So you try to get a risk reward like that. The problem with this is it's extremely difficult for you to say enter anywhere here and have the odds of a candle not coming up and touching, just slightly touching your stop loss before progressing on. And so how can you avoid that? Well, first of all, you need to look at the market condition that you're in. If you're in a condition like this, you must understand that there's a high chance that there's a lot of, price movements. There's a lot of fake out happening. So the market's pushing down and quickly buying up. And then it's pushing up, then kind of buying back down. And if you're a scalper, you want to try your best to avoid that. I'd say widen your stop loss if you are using a stop loss. If you do want to trade this market, alternatively, you can choose to have a strategy that says I will only trade when I see these really cleaner candles. So you see this bearish candle here, it's kind of pushing down, it's pushing down. It's not as aggressively wicking back and forth from the previous candle, like these ones. You don't see one wick after another. It's a lot cleaner. It's just small wicks, then it push down, small wicks, then it push down. In these cases, you'll be much better to take your shot somewhere here if you're looking to short this market, right? You can trade that strategy, and that way you can have um, a smaller stop loss. But in most cases, you're not going to be able to do that. So if you want to have a strategy where you're not just waiting for the market to give you these clean candles to scalp, and you want to get involved when the market is kind of pushing down, but also wicking back and forth, as it's going down, you'll need to understand that if you set a really small stop loss, there's a high chance that you're going to get tagged. And in most cases, you can keep on getting tagged and tagged and tagged. And before you know it, the move has already been done, and then you get involved at the bottom, which you really don't want to be doing. And also, in certain other conditions as well, I know this is not live replay, so I can't really explain this too well. But in places where like market opens at the say I'm on the Euro USD, let's say 8 a.m. I think UK time. I'm not 100% sure for USD, but I know like say for the indices, it's like 2:30 in the UK. So let's say at market open, you try to get involved in a trade with a really small stop loss. What's going to happen there? Because the market is market open, it's moving around so quickly, and you're obviously this is the 5 minute candle, but if you're scalping on the 1 minute time frame as well, uh, I just kind of lost my bearing there. But if you're scalping on the 1 minute candle and you're market open, you still have to understand that it's either you wait a while to see what the market's doing, because at market open, the market kind of just does this. If you ever notice, it kind of shoots up, and it shoots all the way back down, and it shoots up, and and it makes these really large candles. And trying to get involved with that is just a mistake, in my opinion. So, in order to avoid situations where you see this massive green candle pushing up, pushing up, pushing up, you buy here, and all of a sudden it tags you all the way back down here. The problem is these larger candles should not be in your risk parameter if you're trying to get a small, if you're trying to use small stops, if you're trying to have small one-to-ones. If you're taking the market at face value and you're saying, I won't use small stops, but I will use stop losses that are in range of the overall market. So I'll widen my stop all the way up here, and I might widen my take profit all the way down here. Now that's fine. That's fine because you're taking market structure into consideration when you're trading. You're not just randomly saying, "Oh, I must get a one-to-one," or for risk management, or for whatever. Or I need to manage my risk by having a small stop just to not lose too much. The thing is, with the market, you'll just keep on losing, and before you know it, you've lost way too much money. Um, so yeah. Also, a lot of the time, um, in consolidating markets and sideways moving markets and choppy random markets like this, it's extremely difficult to trade. It's extremely unpredictable. So I would personally just avoid trading that if you're a scalper. Look for when the market is trending and trending decently, and I say preferably trending quietly, where you can just get in, get your one-to-one with your tight stop, and get out. And yeah, so that's it. Thank you guys for watching, and that's it for this video today.